Hello, I'm Haider Malik, host of the Memi Financial Group podcast. Today's topic is Reshaping Debt for Growth, Refinancing for Calgary construction firms. Rising rates, project overruns, and seasonal lulls can leave your debt misaligned with your cash flow. Strategic refinancing can lower costs, extend terms, and free up capital for expansion. Here's how Calgary contractors can reshape their debt. 1. Assess your existing debt profile. Inventory all obligations. List term loans, lines of credit, equipment leases, and vendor payables. Note balances, rates, maturities, and covenants. Cash flow mapping. Chart your monthly draws and repayments against project draw schedules to spot mismatches or peak pressures. 2. Refinance objectives. Lower interest expense. Lock in today's competitive fixed rates on term loans or convert floating rate lines to fixed at a modest premium. Extend amortization. Move from 3 to 5 year paydowns to 7 to 10 year terms, reducing monthly principal requirements. Consolidate facilities. Combine multiple smaller loans and leases into a single streamlined facility for easier management and potential rate discounts. Improve flexibility. Add features like interest-only periods, principal holidays, or accordion options to draw additional funds as projects scale. 3. Refinancing structures. 1. Term loan replacement. Replace high-rate short-term loans with new 5-7 year facilities at prime plus 1%. Extend amortization to align with project life cycles, lowering monthly debt service. 2. Line of credit conversion. Convert term balances into an equipment line of credit, ELOC, for revolving access, interest on drawn amounts only. Secure against your fleet appraised at 65 to 75% of current value. 3. Lease restructuring. Swap finance leases into operating leases to shift residual value risk to lessors and remove liabilities from your balance sheet. Bundle preventive maintenance into the new lease to cap unplanned repair bills. 4. Cash flow bridge loans. Obtain short-term bridge facilities to cover any refinancing gap during term loan paydown or sale leaseback funding. Align bridge maturity with your next major project draw to avoid overlapping payments. 4. Lender selection and negotiation. Local relationships. ATB Financial, Service Credit Union, and regional specialty lenders know Alberta's cycles and can structure covenants around seasonal EBITDA swings. Competitive bids. Solicit term sheets from at least 3 institutions. Leverage multiple offers to negotiate spreads, fees, and covenant tweaks. Covenant light options. Seek facilities with minimal financial tests. Avoid fixed charge coverage ratios if your projects are lumpy. Prepayment terms. Ensure no penalty prepayable or step-down schedules to take advantage of sudden cash inflows. 5. Execution roadmap. WAPI. Preparation, weeks 1 to 2. Gather year-to-date P&Ls, balance sheets, aged receivables, equipment schedules, and project draw calendars. Engage a finance advisor to package your refinancing proposal. 2. Term sheet negotiation, weeks 3 to 4. Compare all-in cost, interest, origination, renewal fees, and covenant flexibility. Choose the optimal structure, blend term loans, ELOC, and leases. 3. Due diligence and closing, weeks 5 to 8. Finalize appraisals, legal review of documents, and condition precedent items. Close the new facilities, use proceeds to retire old obligations, and execute any sale leasebacks or bridge loans. 6. Post refinance management. Covenant monitoring. Integrate covenant metrics into your monthly reporting. Maintain a 10% buffer on leverage and coverage tests. Strategic prepayments. Deploy windfall cash, project bonuses, or asset sales to prepay high cost debt and lower your average cost of capital. Facility reviews. At each renewal, renegotiate spreads and consider further consolidation as your credit profile strengthens. Key takeaway. Refinancing isn't just about chasing a lower rate, it's about reshaping your debt profile to match your project cash flows, extend flexibility, and unlock capital for growth. By auditing your liabilities, selecting the right mix of term loans, ELOCs, and leases, and negotiating covenant friendly terms with Alberta savvy lenders, Calgary construction firms can cut financing costs and fuel their next phase of expansion. I'm Haider Malik. Thanks for listening.